Welcome back to InvestorHubX.com. In this video, I'm going to talk about one of the most frustrating and annoying things traders face in the real world: fakeouts. In this lesson, you'll learn what a fakeout is, why fakeouts happen, how to identify them, and most importantly, how to avoid getting trapped by them using proper price action and confirmation. Once you truly understand fakeouts, you'll stop chasing bad breakouts and start trading with much more confidence, patience, and control. Let's get started. So, what is a fakeout? Here is the Bitcoin chart in November 2021. This is the key level. We had a strong green candle breaking out above a major resistance level. When the candle closed, it confirmed the breakout. At that point, many traders thought to themselves, "We've finally broken through the all-time high, clear sky ahead, I'm going all in." But then, this is what happened. Price failed to continue higher, quickly lost momentum, and moved back below the breakout level. That breakout turned into a fakeout. Instead of continuation, the market trapped breakout buyers and reversed direction. This is exactly how fakeouts work. They look perfect at first, but without proper confirmation, they often end in failure. So, why do fakeouts happen? Fakeouts happen because the market is designed to trap impatient traders. At key levels, like all-time highs, major support, or resistance, there is a huge amount of liquidity. That means a lot of stop losses, breakout orders, and emotional decisions are sitting around the same area. When price breaks a key level, it attracts breakout traders who buy late, believing the move will continue. At the same time, smart money uses that surge of buying pressure as liquidity to exit positions or open the opposite trade. Once that liquidity is filled, price no longer has a reason to keep moving higher, so instead of continuation, the market reverses, leaving breakout traders trapped on the wrong side. This is why fakeouts often happen at major resistance or support levels, all-time highs or lows area, where everyone is watching the same level. The breakout looks real. The candle closes strong. But without follow-through and confirmation, the move fails. And that's the essence of a fakeout. So how do we identify a fake out? Let's illustrate this again using the Bitcoin example. Here is the key level. When price reaches this level, many traders immediately think, "We've broken the all-time high. This is an excellent entry." As a result, they enter right after the breakout, without waiting for any confirmation. Most of these traders will place their stop loss just below the breakout level, because that's what they were taught to do. Now here's the problem. Since this is a major level that everyone is watching, there are a lot of long positions and stop losses clustered in the same area. If heavy selling pressure comes in at this level, it will trigger those stop losses all at once. In other words, all the long positions that were opened at the peak get liquidated simultaneously. That liquidation provides fuel for the move in the opposite direction, and that's the mechanism behind a fake out. The breakout looks real. The candle closes strong. But the market uses that breakout to trap late buyers and reverse. So the real question is, how do we get around this problem? The solution is simple. Always wait for price action confirmation. Let price clearly show you a real trend change or reversal after the candlestick has fully formed at a key level. If you're unsure, zoom into a lower time frame and look for clear price action confirmation. On the left, we have the monthly time frame. On the right, we have the 4-hour time frame. It's the same key level and the same trend. This area here, where this candlestick formed on the weekly chart, is the same area here on the 4-hour chart. Now notice what happens on the lower time frame. Price starts to form a lower high. Look at the price action at the top. We have bearish engulfing candles, followed by a bear flag. When price breaks below the bear flag, the trend changes from an uptrend to a downtrend. There is no price action showing bullish follow-through. And that's how we know this breakout was a fake out. So, how do you avoid getting trapped by a fake out? Let's look at this example using Coinbase on the weekly time frame. This zone here is a key support level. Price moves up and comes back down. When price comes back into this area, some traders will automatically go long as soon as they see this bullish engulfing candle. They assume support is holding and the reversal is confirmed. But then, look at what happens next. Price fails to follow through, momentum stalls, and the market reverses back down. Those long positions get trapped. The mistake here is entering based on key support level and a single candle without waiting for trend change confirmation. Here is how we should analyze. On the left, we have Coinbase on the weekly time frame. On the right, we have Coinbase on the daily time frame. This support zone on the weekly chart is the same area you see here on the daily chart. And this bullish engulfing candle on the weekly time frame corresponds to this exact area on the daily time frame. Now, let's step back and analyze the bigger picture first. Price was already in a downtrend. We had a break below the triangle, which is a bearish signal, and confirms the trend has shifted from an uptrend to a downtrend. After that, the retest failed, followed by 3 black crows, showing very strong bearish momentum in the direction of the trend. Now, when price reaches this key support level, some traders decide to go long after the breakout, thinking the support will hold. On the surface, it looks like everything was done correctly. But price fakes out. Why? Because although price briefly broke out, it failed the retest of the trend line. That failure is a trend continuation signal, not a reversal signal. In other words, the higher time frame downtrend remained intact, and the market continued lower. This is why context matters. Support alone is not enough. A bullish candle alone is not enough. You must always respect the dominant trend and wait for proper price action confirmation, including a successful retest. To summarize, fake outs happen when price appears to break a key level, but fails to produce real follow-through. They are designed to trap traders who enter too early without confirmation. To avoid getting caught, always respect the dominant trend, never rely on a single candle or breakout. Wait for price action confirmation, including a successful retest. Use lower time frames to confirm structure, not to predict. When you let price do the talking and wait for confirmation, fake outs become warnings, not traps. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.